Options are derivative securities whose values depend on several underlying market factors. The 6 primary determinants of option prices are the current price of the underlying asset, the strike price, time to expiration, volatility, risk-free interest rates, and expected dividends. A call option generally increases in value as the underlying asset price rises, while a put option increases in value as the underlying asset price declines. The relationship between the underlying price and strike price determines whether the option is in the money, at the money, or out of the money. The program emphasizes understanding option pricing factors because these variables directly influence the risk and profitability of option trading and hedging strategies. The current price of the underlying asset and the strike price are among the most important determinants of option value. For call options, higher underlying asset prices increase option values because the right to purchase the asset at a fixed strike price becomes more valuable. Conversely, put options become more valuable when the underlying asset price declines below the strike price. The strike price itself has an opposite effect on option values. Higher strike prices reduce the value of call options but increase the value of put options. These relationships reflect the intrinsic value of options, which measures the immediate economic benefit from exercising the option under current market conditions. Time to expiration significantly affects option prices because longer maturities provide greater opportunities for favorable price movements. In general, options with more time remaining until expiration are more valuable than otherwise identical short-term options. This additional value is referred to as time value. Longer maturities increase the probability that an option may become profitable before expiration. Time decay, commonly known as theta, represents the gradual decline in an option's time value as expiration approaches. While both calls and puts are affected by time decay, out-of-the-money options are particularly sensitive because much of their value depends on the possibility of future favorable price movements occurring before expiration. Volatility is another critical factor influencing option values because it measures the expected variability of the underlying asset's price. Higher volatility generally increases the value of both call and put options because greater price fluctuations raise the probability that the option will finish in the money. Unlike many other financial instruments, option holders benefit from uncertainty because their downside risk is limited to the premium paid, while upside potential may be substantial. Risk-free interest rates and expected dividends also influence option prices. Higher interest rates tend to increase call option values and decrease put option values, while expected dividends generally reduce call values and increase put values because dividends lower future stock prices. Option pricing theory also establishes upper and lower bounds for option values to prevent arbitrage opportunities. For call options, the upper bound is generally the current price of the underlying asset because an option should never be worth more than the asset itself. The lower bound reflects the intrinsic value of the option, ensuring that in-the-money options cannot trade below immediate exercise value. Similar principles apply to put options, although the calculations differ because puts gain value from declining underlying prices. American-style options are typically at least as valuable as European-style options because they offer greater exercise flexibility. Pricing bounds help traders identify mispriced options and maintain efficient market pricing relationships. The program highlights option pricing factors and pricing bounds as essential concepts for managing derivative risk and constructing trading strategies. Accurate option valuation is critical for hedging, speculation, portfolio insurance, and structured financial products. Financial institutions and investment professionals rely on option pricing models to evaluate market exposures, estimate sensitivities, and implement risk management programs. Because option values respond non-linearly to changes in market conditions, understanding the interaction among pricing factors is particularly important. Upper and lower pricing bounds further support market efficiency by limiting arbitrage opportunities. Mastery of option valuation principles is therefore fundamental for financial risk professionals involved in derivatives trading, portfolio management, and market risk analysis.